Hi to everyone. Welcome to the 14th episode of Open Lecture Series in FinTech for Everyone, which is an open lecture series of iCrypex FinTech Masters program. This week is, of course, with lots of drama about cryptocurrencies, leading with the Terra blockchain system. On the other hand, we also have a higher than expected US CPI value with 8.3. So today's episode will be covering these two main topics. Of course, the main agenda is discussing about the policies of central banks, and also, since our main drama is Terra blockchain, Luna cryptocurrency, and UST, we will be also discussing about trying to be central bank type of blockchains. Will there be effective? Will this drama infectious for other cryptocurrencies as well? As usual, Burak Tamac from USA is joining us. Hi, Burak. Welcome. How are you? How is everything? Burak, we can't see you. We can't hear you. Sorry.
Yeah, I'm good. So we have a very hectic week, as you all know, and this not only to the crypto market but also the CPI, and everything is like coming every day. We have new news, and that change the narrative in the market. So I'm excited to be here to cover and discuss with you the recent developments.
With pleasure. Many thanks. So if you agree, let's start with a brief explanation of what's going on in the cryptocurrency markets, why the prices are declining so harsh, what's going on, what are the underlying reasons, and then we can continue with the recent data about US CPI, okay? So first of all, there is, of course, not only one reason why we are seeing so much volatile markets, so much red screens everywhere, not only for cryptocurrencies, but also for the indexes like Nasdaq, S&P 500, etc. As we have discussed in the previous episodes, the main underlying reason is a paradigm shift in the monetary policies. Throughout the pandemics, we were in expansionary monetary policies periods, and since a couple of months ago, Fed declared that now there will be a shift to manage with the higher than ever inflation rates in USA. Now there should be also an accompanying interest rate increase, in general, a monetary contraction. So there are a couple of tools, of course, for monetary contraction. There will be an adjustment of the balance of the sheets, but it has all started with first a 50 base point increase in the interest rates. And not only this, Powell also announced that this will be just the beginning. In the meetings of June and July, this 50 base points increase will continue. So historically, these are very, of course, high and harsh increased rate interests, which is changing the attitude towards risk for all type of investors. And throughout the pandemics, we have seen a huge increase in the technology stocks together with cryptocurrency valuations, and now it looks like since the risk appetite is shifted and decreased, now the increase in the interest rates, the forthcoming increases in the interest rates are kind of inviting the USD holders back to the safe zones. So this is the number one reason, I guess, but together with the Ukraine and Russia crisis, and also together with the quietly increased energy costs and also other increase in the prices of the food industry. These are all affecting the costs of producers in a global wide way. So the costs are increased, the uncertainty is increased. We accompanied with a monetary contraction shift. Then, of course, the risk preferences are now adjusting themselves accordingly, which means the higher risk returns are not as much as attractive as before. So on top of these three main reasons, we should also mention about the China. Unemployment rate in China is also not kind of under control. We are also still seeing some kind of quarantine measures in Shanghai and Beijing. So these are adding extra uncertainty to the volatile market conditions. So, but recently, since last 3 days, we are seeing another type of drama, which has rooting causes in blockchain ecosystem, not somewhere else, and that is basically showing us why decentralization should not be just like an utopia or just like a fancy world, but if any project, any blockchain is just seemingly decentralized, but in a sense so much centralized, there will be always risks associated with them. So to have a brief summary about what's going on about Terra blockchain, we need to have a brief understanding of stable coins. Maybe it will be nice to also share the screen so that the audience can see the UST pricing. So as you see recently, now it is UST, which is supposed to be a stable coin pegged to $1, which means the value of UST should be approximately equal to $1, is now 0.69 cents. And if you just check the data throughout the hourly based way, you see that today, I mean, USD was as low as 22 cents today. So unbelievable. I mean, if something is supposed to be equal to $1 by definition of stable coin, it should be stable. So what's going on here? What is USD, and what is the main difference of USD compared to other stable coins, which are like the safe zones of the crypto ecosystem? We will briefly discuss about it. First of all, let's begin with the basic definitions. We all have a tendency to describe all of the cryptocurrency market products as cryptocurrencies, which is unfortunately not true. So let's have a main distinction. The first criteria should be decentralized, meaning that if we see a project based on blockchain protocols, and if we see that there is no company behind that project, then we can comfortably call that as a cryptocurrency or a crypto asset, since the crypto there is almost equivalent to the decentralization spirit of that project. On the other hand, as we check the cryptocurrency projects, many projects are, as let's say, pseudo decentralized. For example, we have lots of centralized exchanges, which are, of course, the locomotive of the ecosystem, because majority of the users are trading through those centralized exchanges. And for almost all of centralized exchanges, they are coming with their own asset. For example, for Binance, we have BNB. For other exchanges, they have their own coins, and these coins are by definition centralized, because there is an exchange behind it, which is trying to support that coin with some assets, with some other assets. If it is like the case of BUSD, which is the stable coin pegged to $1 that is supported by a company, Paxos, and supported with also Binance. So these are, in that sense, I would call them not as cryptocurrencies, but digital currencies. On the other hand, of course, Bitcoin and Ether, they are not belonging to anyone. They are not supported by a single company, so they are cryptocurrencies. They are decentralized. So the whole picture is, I think, messed up with a misunderstanding of the stable coins and misunderstanding or missing the decentralization level of these coins. Well, if we put decentralization as the main criteria to call a project either a crypto asset or a digital asset, then the only main crypto asset as a stable coin is DAI. DAI is by MakerDAO. MakerDAO is, as the name suggests, it is actually a decentralized autonomous organization. And so as the locomotive project of the decentralized finance, so MakerDAO started a new period in a whole blockchain ecosystem by this simple idea. If you have crypto assets like Bitcoin, Ether, and other crypto assets, but it all started with Ether historically, then if you think that you should hold Ether for a long time, but still at some point you need to have some kind of liquid assets, then you can use that Ether as a collateralized amount. And by staking or locking that Ether in the through the smart contracts in MakerDAO, then you can mint a stable coin, which is called DAI. So this is historically one of the most successful stablecoin projects. And since it is backed by a decentralized autonomous organization, it is like the only successful stable coin. And we can safely say that it is a cryptocurrency. It is a crypto asset. On the other hand, we have some other successful stable coins like USDC, backed by the company Circle, backed by the centralized exchange Coinbase. So USDC is also another quite successful stable coin, but it is not decentralized. It is backed by companies. And these companies are also backing the USDC not to lose its peg equal to $1. They are backing these stable coins together with BUSD, USDC. In the bank accounts, they are backing these currencies with actual dollars. There's another exception like USDT. USDT is also backed by a company and also another centralized exchange. Well, for USDT, there is no one-to-one backing plan, but still they are trying to for the sustainability of the project, they are doing their best to support USDT project and backing by some other assets other than the actual fiat currency USD. So then if we are now comfortable with the main concepts of stable coins, what is UST? What is the drama behind UST? Why we see a stable coin not equal to $1? Well, so there are, as we have already mentioned, there are two main types or two main mechanisms to protect the peg of these stable coins. For DAI project, the first DeFi decentralized stable coin, there is a mechanism with over collateralization, meaning that for every DAI minted in the market, there is a supporting mechanism, a collateralization with cryptocurrencies and with more than the ratio of 1-to-1, meaning that there are more crypto assets backing DAI with over collateralization, so that if there is a supply or demand shock about DAI, that over collateralization protects the peg of DAI so that it is almost equal to 1. It is never exactly equal to $1.0. Sometimes it is 1.001 or 0.999, etc. But this dynamic mechanisms makes DAI project sustainable due to the over collateralization by crypto assets. And now it is not not only Ether, but it is also other crypto assets for DAI. On the other hand, for USDC and for BUSD, the supporting mechanism, the backing mechanism is not through other crypto assets, but it is through bank accounts. So since they are backed by the companies, those companies are backing those projects, USDC, BUSD, partially for USDT. They are sustaining the peg throughout USD reserves, fiat money reserves. Of course, the ratios change from project to project. And as you see in the screen for Tether, it is not similar to BUSD or USDC. Well, now let's come to UST. UST is the stable coin of the Terra blockchain. And in Terra blockchain, the main utility token is Luna token. And the idea is this. Since people, investors, traders, users of the cryptocurrencies need sometimes those stable coins as the safe haven, meaning that if the markets are too volatile, if there's an expectation that the BTC and the Ether and the other cryptocurrency valuations will decrease in time, people, instead of just selling those coins and switching to fiat currency, they can buy those stable coins. And actually there are lots of protocols in DeFi ecosystem, also throughout central exchanges. You can earn an interest rate high above than the interest rate provided by the central bank of Fed, for example. And UST project was kind of exploited this interest rate return for dollar. There is a protocol called Anchor, which is the credit protocol of the Terra blockchain, to make UST attractable. The returns for USD, meaning that to the dollar, we have seen 20% APY. So of course these are extremely high. I mean, once you check the banks, the offered real interest rates are actually negative. So a 20% real return for USD is, of course, attracted lots of investors to USD. But USD is using another type of supporting mechanism to protect the peg, not with crypto assets, not with crypto assets like MakerDAO, not with a bank account like BUSD and also with USDC. But the main idea supporting the peg for USD is backing it with the Terra blockchain's natural coin, Luna coin, meaning that to buy UST, you need to provide Luna to the system. Of course, this means that if you are demanding UST, then there should be a higher demand for Luna as well. Or vice versa. If you are selling UST, then there will be an equal selling pressure for Luna coin as well. So this is the main difference of UST than the other stable coins in terms of its sustainability of the peg mechanism. So this is broken. All of the drama about Luna and the UST is this actually. So because this system works with the assumption that as long as there are use cases for Luna, as long as there is a higher demand for Terra blockchain, which is in principle designed by also cooperations with other blockchains like Avalanche and like other blockchain ecosystems. So of course, with the hype of the NFTs, metaverse projects, the assumption was as long as there is a demand, continuous demand for Luna, with the type of credit protocols like Anchor, there will be demand for UST with 20% APY or yield mechanism. So as long as the demand is continuous, this is a sustainable mechanism. But the things are crashed once we have seen this decrease in demand for all cryptocurrencies with the underlying reasons that we have mentioned at the beginning. So then we had seen a kind of chain reaction. So the demand for USD decreased, but the chain reaction started with also some other insiding operations for which the details can be read in detail with the link that we will provide in this video. So the main idea of supporting UST with the Luna demand. So this is unfortunately broken because Terra blockchain is not decentralized. There could be some insider operations because Luna is not as decentralized as Ethereum protocol, for example. If you give an incentive or if you give an opportunity to someone, if there is a chance that for someone or for some group to have some manipulations in the main mechanism, in the main supporting mechanisms, at some point, that would happen. And unfortunately, we are seeing now the crash of USD, the crash of Luna, and from the Luna Foundation, we see that they are considering about recovery mechanisms. They are updating the collateralization. So Luna Foundation was criticizing the DAI due to its over collateralization method, but now they are considering the same mechanism, etc. Of course, the communities and the foundation will decide on that, but we see a drama, and this drama is unfortunately infectious, meaning that the uncertainty about the survival of USD, if it will be repegged to $1 or not, for repegging USD to $1 again, what will be the cost? First, there were some collateralized BTC amount there in the reserves. Now we see also sell pressure on AVAX because it is also in the reserves. So it is triggering the crisis there, and this spreads to the also the other cryptocurrencies. So everyone is watching the drama with, of course, concerned eyes. So Burak, it was a kind of quite a long description, but I think the issue is so critical that many people are kind of just trying to understand what's going on. Hopefully, I could provide a brief explanation. Please continue with your comments, and then we can switch to the CPI and the effect of inflation in the markets.
There's nothing to add because my technical side is the weakest side in terms of the how blockchain or like crypto projects work, and I understood all the explanation which you gave, which I don't come from a technical perspective, technical background, so I think it was very good explanation to even just like someone like me who doesn't know the technical part really well could understood. Though I just wanted to stress and emphasize the last part about the demand, because these kind of projects, as far as I understand, could be successful and sustainable in the market. It's even slightly upward trend because there should be a demand to support your mechanisms. But since November 2021, because of the macroeconomics and everything going on in the ecosystem, we have seen also like Bitcoin and other blockchains too, the demand and activity is going down. I think when they go down, the demand goes down, these projects become much more vulnerable to certain attacks. I think we've been experiencing something like that.
Exactly, bro.
Okay, so now we can cover quickly the CPI measures today. I would like to share my screen again. So what we have seen today is the most important part is obviously the CPI and the core CPI. So this is the core CPI today. It came around 6.2. With the forecast was 6 point, but the last month's CPI year over year is 6.5, and the other one is the CPI, not the core CPI, but the general CPI, so to speak, it came it came 8.3, and it was expected 8.1. It's a little bit higher than that, but it was lower than the previous one. So what I would like to emphasize here, before I share the narrative change that I'm expecting because of the CPIs, how they came out today, I want to actually say the but part at the beginning. The but part, like I will explain the narrative change. It is good for the economy that inflation may have peaked last month, but the but part is month over month CPI. It actually increased more than expected. So it was 0.6%. So let me tell you about the narrative very quickly, why we are here and where we're going. So this is the CPI for 1 year. As we all remember that the Fed started to talk about tapering November. It's right here. So November, at the time, we've seen that the CPI before it was 5.4, 5.3, 5.4, then it became all of a sudden 6.2. And everybody was like started to question the transition, I can't say that, transition fashion of the CPI that Fed was like talking about. And then what we have seen that if we remember what Fed decided in November, $15 billion tapering per month, ending purchasing assets in June, and increasing the first increased interest rate July maybe. So we are in May. We are already seeing the tapering already ended. The purchasing the assets from the open market already ended, and we have seen already 0.2075 increase in the rate. So why that happened? So every single time since November, Fed became more aggressive because the inflation increased every single time too. But also the macroeconomy is expected to CPI to peak in March and the first quarter, and then go down after that. It didn't because of the energy crisis caused as a consequence of the Russia invasion to Ukraine. So after that, I've seen more and more comments that the CPI will peak June or July, and then it will go down afterwards. But everyone also expecting the CPI to go up, obviously peak in June or July. But we have seen lower this month. I think this is very, very significant because for the first time, Fed started to talk about tapering, shrinking the balance sheet, everything we've been hearing for the last 6 months was based on this continuous trend in CPI. But we may have peaked last month. We don't know yet. And good thing is that before the next FOMC meeting in June, we're gonna see another CPI couple of days or 4 or 5 days before the FOMC meeting, maybe 5 days before, 6 days before, so that if the next one also comes below 8.3, which is still high, but this will support a narrative that we may have peaked in actually April, and now the downward trend has started. If this happens, let me go back here. If this happens, so maybe you remember, John, like a couple of weeks ago, I said the cryptocurrencies and Bitcoin cannot really diverge from the Nasdaq indexes because there's a fire inside the house. They are inside, and the fire, I said, is because of the inflation. So if we have seen that the fire is not getting worse, but it's getting a little better, we will be able to actually predict what Fed will do in the next 6 to 12 months. We weren't able to do that 2 months ago. No one know what Fed is going to do because there was a big problem the inflation is getting out of control. That was the narrative, because it was constantly increasing every month. If we take this out of the equation, then the market will see ahead more predictable way, more I would say that the market will trust that Fed will not change course in the maybe next year or maybe next 6 months, because Fed has been changing the course of intensity of their policies because of the inflation. I think this is very, very critical. On top of that, the supporting another thing is the core CPI year over year also decreased from last month. Last month was 6.5, 6.2. So sorry. So the core CPI also went down from last month. So we might have even peaked in core CPI last month too. That excludes food and energy. This is also like core CPI also supports this narrative change that I've been following very closely. And one last sentence about that: the hourly earnings also supporting this narrative, because last week we've seen the hourly earning reports, and it actually increased less than expected. If the earnings are not going as fast as or higher than the expectation, that means they're not going to be feeding the inflation to out of control levels. So the earnings not going as fast, CPI is going down too. These two indicators will support each other to a narrative change that CPI may not get out of control or over 10%, 15%. I think this is very significant, and this will help us to but understand that the Fed is Fed is going to do, and that might help to Bitcoin or crypto assets to diverge from the Nasdaq S&P 500.
Burak, I think especially your analogy with from the previous episodes, like there's a fire in the house. So this is for the explaining that, and in the mass media we see a lot of criticisms like, oh, Bitcoin was an alternative system. So if there's a higher than ever correlation between Nasdaq and Bitcoin's price, then is the promise of Bitcoin failed. So together with this Terra blockchain drama, we see lots of harsher criticisms like, oh, these are Ponzi schemes. I mean, even Bitcoin is like that. So since many people are just confusing and not understanding even the fundamental differences between the stable coins, cryptocurrencies, digital currencies. So some criticisms for one project is also understood as an overall criticism for all cryptocurrencies. And especially in that sense, to understand why Bitcoin is also with highest correlation with Nasdaq, this analogy is important. So to briefly describe it one more time, in the uncertainty plus high inflation plus risks of recession plus monetary contraction plus the unemployment data from the China and Russia and Ukraine crisis, affecting all of the costs and uncertainty about energy and the food prices. So these are all indeed constituting a fire in the house. So people are basically in uncertainty, in darkness. So as you have nicely put, of course, the predictability, at least some type of room for predicting the future, to allowing for adjusting the expectations is the crucial thing for deciding on investment preferences, how to allocate the resources for risk assets, how to allocate them for safe assets, and etc. So during these type of fire periods, fire in the house moments, of course, the basic reaction is, okay, just wait and just park in a safe zone and wait and see. That's why cryptocurrencies, Bitcoin especially, is showing high correlation with the indexes, because especially the institutional investors, the hedge funds, are showing similar patterns in investing in the stocks or deciding not to invest in stocks in parallel to investing in cryptocurrencies or not. And another difficulty added to the picture is, I think everyone now agrees, even Fed accepts, that Fed was late to intervene the situation, to switch to the monetary contraction, because the main uh, announcement was, oh, this inflation is temporary. It is not. I mean, we will be in inflationary periods for a long time. Hopefully a recession will not add to that. So now this is the main risk. Of course, these are the main underlying reasons. There is one important question from our audience by Danish coach: what will be the effect of CBDCs on stable coins? I think it is quite important, because unfortunately the drama in the blockchain ecosystem is the main thing which is needed by also regulators to intervene the ecosystem, because since it is evolving too much, if everything is going well, then any type of intervention would be reacted with lots of criticisms. But when there are kind of crises in the ecosystem, I would say, unfortunately, this also provides room and provides a kind of need for extra regulations. Hopefully, everyone will be acting in a calm way, because we have kind of two recent important announcements. One is from Janet Yellen. One more time, they have announced that, oh, there should be immediate regulations for stable coins. Of course, the whole story started with Stable Act, which can be found in our previous episodes, the detailed discussions of those, because stable coins are, we should all accept that, of course, a distractionary mechanism for central bank policies. But it is the preference, it is the choice to either understand the potential of these stable coins, including another innovative tool which might ease the effectiveness of the monetary policies, or someone can see it as a threat to create a kind of extra material for financial instability. Hopefully, it will not be the second case. Hopefully, the central banks will understand all of the potentials of using those central bank digital currencies or stable coins in a kind of cohesive manner, in a kind of coherent manner, so that these tools can support each other. These tools need not to be a threat to each other. But as we see the dramas, I'm kind of concerned that regulations starting with stable coins might come sooner than expected. Let's see altogether, and hopefully the main reason by the problems with the blockchain projects can be understood in a crystal clear way. If you see a hack, if you see an attack, if you see a kind of crisis in a blockchain ecosystem, the number one thing that anyone should check is the decentralization level. No project is fully decentralization. It is like the utopia level. Everyone accepts that. But some projects are not even in theory decentralized. They are even in theory, they are centralized, in practice even fully centralized. And I think comfortably say that, let's say with 1% confidence interval, 99% of all of the problems or crises in crypto projects, they are due to some centralized issues, not to the decentralized features of them. Meaning that if you check the decentralized ones, if you check the real cryptocurrencies, actually they are sustainable, they are growing in a sustainable way, and not in that sense harming anyone. They are instead shedding a light to how successful monetary policy can be designed. So these are kind of my last words. If you want something to add, Burak, you are more than welcome. You are muted.
I don't have anything to add. It was a very good summary at the end, because this is the most important thing in the everyone declares that they are decentralized. But when it comes in practice, when we ask the why question, something happens why. If we dig a little more, we see the centralized portion of it usually causes these problems. And it's always too good to ask the why question. That's why we are in academia. We are learning to ask why question and try to direct our interests, our knowledge to right places.
Many thanks, Burak. So for our viewers, we will add links just to this below of the YouTube video, so that if you have an interest in understanding for example, the full mechanism behind the UST. Today, as we have also shown to you, there is now a recovery process going on. So for all of the details of the recovery process, for understanding the details of the UST, in which way it is different than the other stable coins, as I tried to briefly explain, for all of the interested audience, you can read those links. You can read the material in those links, so that you will have a better understanding of the projects. Maybe, hopefully, you will be among the ones who will be part of some DAOs and some really decentralized crypto projects. So many thanks for your time and questions. Burak, many thanks for all of your contributions, and looking forward to seeing you next week in another FinTech for Everyone episode. Cheers. Bye.
Bye.